All right, let's go ahead and get started. Welcome everyone to this month's First Wednesday Tax Update. My name is Bruce McGovern. I'm a member of the faculty at South Texas College of Law, Houston, and a member of the Council of the State Bar of Texas Tax Section. And each Wednesday, on the first Wednesday of the month, we get together online and talk about recent developments in federal income taxation. So this webcast is an initiative of the State Bar of Texas Tax Section. Now, as materials for today, you should have an outline of recent developments, and that was sent out sometime this morning to those who had registered as of early this morning. If you did not receive it, you can still download it from this link. So simply go to https://tinyurl.com/outline 1219. So if you don't have the outline and you'd like to get a hold of it right now, you can go ahead and download it through that link. Now, the slides will also be available at the other link that's indicated here, which is the same one, except it is slides 1219. The slides are not yet available through that link, but they will be immediately after the webcast. Now, I am doing the webcast today from the heart of Washington, D.C., which seems like an appropriate place to be talking about taxation. And I'm here attending a conference sponsored by the IRS for those who work in low-income taxpayer clinics. So at the law school at South Texas College of Law, Houston, I both teach tax, but I also direct our low-income taxpayer clinic. And so I'm here for most of the week for sessions on topics related to that. It's been quite an interesting session. We heard yesterday from Michael Desmond, who is the chief counsel of the IRS, and today from the acting taxpayer advocate with the IRS Taxpayer Advocate Service. So if during the webcast, if you should hear sirens or other sorts of noises, that is why, because just outside my window, there's a lot going on here in Washington, D.C. So let's go ahead and talk about our first item, which is on begins on page 3 of the outline. And actually, before we get into the first item, let me also remind people that if you do have a question as we're discussing these items, please feel free to ask them. And you can do that through the chat feature, which is built into the software. And so at the top or bottom of your screen, you should see a link for the chat feature. And you can ask your question that way, and I'll do my best to respond to those questions. Now, on page 3, item 1 is a discussion of some changes made by the Tax Cuts and Jobs Act, the legislation enacted at the end of 2017, which took effect for the most part in 2018. And in the Tax Cuts and Jobs Act, Congress made a couple of changes in the area of accounting methods. The first of those is summarized here and in the outline on page 3. And Congress specifically amended Section 451B, and the amendment applies to accrual method taxpayers and requires accrual method taxpayers to treat the all events test as satisfied no later than a specific time. Now, recall that the all events test says that an accrual method taxpayer must recognize income when all events have occurred to establish the amount of the fact of the income, and the amount of the income can be determined with reasonable accuracy. And historically, taxpayers, accrual method taxpayers, have sometimes had a disparity between their book treatment of income and their tax treatment of income. And the general strategy is to try to recognize the revenue more quickly for book purposes so that financial statements look good, and to defer the income for tax purposes, to defer paying tax. And so to combat that sort of strategy, Congress made this amendment, which provides that an accrual method taxpayer must treat the all events test as satisfied no later than the time when the revenue or portion of the revenue is taken into account in either an applicable financial statement or another financial statement specified by the IRS. So the idea is that if a taxpayer has an applicable financial statement as defined, and we'll talk about what that is, then they have to recognize the revenue for tax purposes upon the earlier of the all events test being satisfied, or when they recognize the revenue in an applicable financial statement. Now, an applicable financial statement is defined, and specifically, it is defined as one of three things. The first is a financial statement prepared in accordance with generally accepted accounting principles, so a GAAP financial statement. And if that GAAP financial statement is used for one of three purposes, and those are, first, if it's on a 10K or other statement to shareholders that's required to be filed with the Securities Exchange Commission, or if it is an audited financial statement that is used for credit purposes or reporting to shareholders, partners, or other substantial non-tax business purposes. Now, that second category is fairly broad. The first one's fairly narrow because that's generally going to be publicly traded companies. But the second category is much broader. But the key is it has to be an audited financial statement that's used for one of those purposes. So, for example, if a taxpayer with an audited financial statement were to provide it to a bank to obtain a loan, that would fall into the second category. It's used for credit purposes. Or finally, if that GAAP financial statement is filed with another federal agency for purposes other than federal tax purposes. So that's the first category of an applicable financial statement. Now, the other possibility is we could have certain financial statements that are made on the basis of international financial reporting standards and filed with agencies of a foreign government. And finally, a financial statement that's specified by the IRS that is filed with any other regulatory or governmental body. So the first type of applicable financial statement is obviously going to be the most common. So putting that all together, if a taxpayer has an applicable financial statement, they have to recognize revenue, despite there being an accrual method taxpayer, upon the earlier of the all events test being satisfied or when they take the revenue into account on their applicable financial statement. Now, the recent development is on page 4 in the outline, page 4, and that is item B. This is a set of proposed regulations that were issued in September of this year, and specifically, the proposed regulations provide guidance on this change that was made by the Tax Cuts and Jobs Act. And so, for example, the proposed regulations provide that this income inclusion rule, which they refer to in the regs as the AFS income inclusion rule, it applies to taxpayers, only to taxpayers that have an applicable financial statement, and if the applicable financial statement covers the taxpayer's entire taxable year. Now, the second, or a second thing that the proposed regulations do is they provide that the applicable financial statement income inclusion rule applies on a year-by-year basis. So, for example, a taxpayer could have an applicable financial statement in one year, but not in another. And the regs say, well, in that case, you're subject to this rule in the year you do have an applicable financial statement, and you're not in the year when you don't have one. A third thing that we find in the proposed regulations is a reiteration of something that I think is fairly obvious, that this income inclusion rule that was enacted by Congress does not change the applicability of other provisions of the code, such as exclusion provisions or non-recognition provisions that we find in the code or the regs or in other published guidance. And finally, the proposed regs clarify how this rule applies in various circumstances, and the regs, of course, provide definitions of certain key terms. So that's the first change in the accounting method area, is this income inclusion rule, and we now have a set of proposed regulations addressing that. Now, a second change that was made by the Tax Cuts and Jobs Act is set forth back on page 3. Let's start there. Item 1 in the outline. And the second change applies to accrual method taxpayers that receive an advance payment. Now, for financial accounting purposes, of course, if an accrual method taxpayer receives an advance payment, that is payment for goods or services to be provided in the future, then for book purposes, the taxpayer takes that into account in the year when the services or goods are provided, not currently in the year of receipt. But for tax purposes, there's a line of Supreme Court cases that established that an accrual method taxpayer generally must include an advance payment in income in the year of receipt, despite the fact that the taxpayer uses the accrual method. Now, there's been an election available for quite a long time. It was established in Revenue Procedure 2004-34 that provided a deferral method of accounting. And essentially what Congress has done is codify that deferral method of accounting through amendments to Section 451C of the code. And what the legislative change says is that an accrual method taxpayer that receives an advance payment can either include the payment in income in the year of receipt, or they can elect to defer the category of advance payments to which that advance payment belongs. Now, what happens if a taxpayer chooses the second option? What if instead of including the payment in income in the year of receipt, they elect to defer it? Well, in that case, what the statute says is the taxpayer has to include in gross income in the year of receipt any portion of that advance payment which is required to be included in income by the applicable financial statement rule that we just talked about. So if the taxpayer takes some portion of the payment into income for book purposes in the year of receipt, they would have to do so for tax purposes as well. Now, as far as the balance of the payment, if they make this deferral election, then they can defer the balance of the payment until the year following the year of receipt. So that is the deferral election that is now authorized by Section 451C of the code. And again, this essentially codifies what we commonly refer to as the deferral method of accounting authorized by Revenue Procedure 2004-34. Now, there's been a recent development with respect to this legislative change as well, and that is again, a set of proposed regulations, which in the outline is over on page 4, item 1, and page 4, item C. Page 4, item C, and these proposed regulations do a few different things. One is they define what an advance payment is, and specifically provide, as does the statute, that an advance payment does not include several specified categories. And some of the more prominent items in those categories are rent, insurance premiums, and payments with respect to financial instruments. So those are all not considered advance payments for this purpose, and therefore are not subject to this deferral election. Now, the proposed regulations divide taxpayers into two categories, and those are, first, taxpayers who have an applicable financial statement, as we just defined it, and those who don't have an applicable financial statement. And they provide a deferral election for both categories of taxpayers. So this election is available even to those who do not have an applicable financial statement. And specifically, the regulations provide, the proposed regs, say that a taxpayer with an applicable financial statement that receives an advance payment can either include it in gross income in the year of receipt or elect to use what they call the AFS deferral method. What is the AFS deferral method? It's the method we just talked about that's specified in the statute. That is, the taxpayer has to include in income in the year of receipt any portion of the payment that they have to under the applicable financial statement rule in 451B, or they can elect to defer it. So if they elect that deferral method, they may have to include some of it in income in the year of receipt under 451B, and to the extent they don't, they can defer it to the following year, as long as they're deferring the entire category of payments to which that payment belongs. Now, if the taxpayer does not have an applicable financial statement, then the regulations provide that the person can include the advance payment in income in the year of receipt, or can elect to include the advance payment in income in the year of receipt to the extent it is earned. So for example, let's say it's an advance payment for services and some of the services have already been provided, but some portion of the services have not. In that case, if the taxpayer uses this method, they would include an income in the year of receipt, the portion of that payment that's been earned, and then they include the remaining amount of it in income in the next taxable year. So that is the change in this area. Two sets of proposed regulations, both dealing with legislative changes to Section 451. Now, from here, let's go to page 8 in the outline. And the write-up of this actually begins on page 5, but the recent development is over on page 8. And as background to this, we now have a set of final regulations. But the background is, recall in the Tax Cuts and Jobs Act that Congress made changes to the additional first-year depreciation that we commonly refer to as bonus depreciation under Section 168K. And prior to this change, if a taxpayer put qualifying property into service during the year, they could elect to deduct right away in that year 50% of the cost basis of the item, and then depreciate the balance, the other 50%, under the normal rules. Well, the legislative change was that for qualifying property, the taxpayer can go ahead and deduct 100% of the cost of the property. Or, as I like to refer to it, Congress gone wild. Don't worry about capital expenditures anymore. We're just going to allow you to write off everything right away. So that is the change. So for qualifying property that is acquired and placed in service after September 27, 2017, the taxpayer can go ahead and deduct 100% of the cost of that property. Now, what if the property was acquired before that date, before September 27, 2017, and placed in service afterwards? Well, if it was placed in service in 2017, the percentage deductible is only 50%. If placed in service in 18, it was 40%. And if they placed it in service in 2019, it's 30%. How might that situation arise? How might somebody have acquired property before September 2017 and be placing it in service in 2019? Well, one situation where that can arise is conversion of a vehicle from personal to business use. And in that case, if the person converts it from personal to business use, they say bought it in 2016 or early 2017, used it for personal purposes, and then converted it to business use in 2019, they would be eligible for bonus depreciation on that, subject, of course, to the limits under Section 280 Cap F on depreciation. Now, the other change made by the Tax Cuts and Jobs Act is that used property is now eligible for bonus depreciation, again, if it was acquired and placed in service after September 27, 2017. Before that change, it had to be new property. So these are very significant changes which are having effects in several different areas, one of which is in the corporate corporate mergers and acquisitions area. So for example, if a corporation is trying to determine whether to acquire the stock or the assets of another corporation, I think there's always been somewhat of a preference for an asset acquisition to get increased basis, and now there might be even more of an incentive, because to the extent you acquire the assets and they're eligible for bonus depreciation, you can go ahead and deduct the cost of those right away. So what is qualifying property for this purpose? As a general rule, the biggest category is property that has a recovery period of 20 years or less. So 20 years or less. There are some exceptions to that, but generally that's what we are looking for. Now, the recent development is over on page 8. It is item F. And in page 8, item F, there's a summary of final regulations that were issued in September of this year on bonus depreciation. And the regulations go into a great deal of detail. I'm not going to walk through the details of the regulations, but there are a couple of things I'd like to highlight from them. And one of those is that the regulations provide a great deal of guidance on situations in which taxpayers are and are not eligible for the 100% bonus depreciation. And one of the biggest areas of concern is with respect to used property. When can a taxpayer deduct 100% of the cost of used property? And essentially what the final regulations say is if neither the taxpayer nor a predecessor had a depreciable interest in that property before. So it's got to be qualifying property in the first place, but neither the taxpayer nor a predecessor can have had a depreciable interest in that property previously. And so one of the issues that arose under the proposed regulations is what is a predecessor? And in the final regulations, the Treasury and the IRS provided a definition of predecessor. And it is the sort of definition we might expect. So for example, if a taxpayer acquired it in a carryover basis transaction, then generally they are going to be deemed to have acquired it from a predecessor, or in other words, the transferor would be considered a predecessor of the taxpayer. Another situation where this comes up is if a decedent holds depreciable property or held it while alive, and then the property passes to his or her estate upon that person's death, then the decedent is a predecessor of the estate. So we have some guidance on those rules in the final regulation. The other aspect I wanted to comment on is one that's indicated here on the slide, and that is that in the Tax Cuts and Jobs Act, there is a legislative glitch which has not been fixed. And that is with respect to what's known as qualified improvement property. Before the Tax Cuts and Jobs Act, there were 3 categories of property that were essentially real property, but that nevertheless were eligible for a Section 179 deduction and for potentially for bonus depreciation. Those were qualified leasehold improvement property, qualified restaurant property, and qualified retail improvement property. In the Tax Cuts and Jobs Act, Congress consolidated all of those into a single category, qualified improvement property. And that is defined as improvements to the interior portion of a building that are placed in service after the date on which the building is placed in service. So that's the definition: improvements to the interior portion, not the exterior, but the interior portion of a building after the date on which the building is placed in service. And the legislative history of that change in the Tax Cuts and Jobs Act provides that qualified improvement property is to have a recovery period of 15 years. Well, if it has a recovery period of 15 years, what does that mean? It means it would qualified improvement property would also be eligible for bonus depreciation. The problem is Congress did not actually provide for that recovery period in the statute itself. And so if qualified improvement property does not have a 15-year recovery period by statute, what recovery period does it have? Well, it's real property. And for that reason, it's going to have a recovery period of 39 years. And that means necessarily that it's not eligible for bonus depreciation. Well, in the preamble to the final regulations that were issued in September, Treasury and the IRS commented on this technical glitch, recognized that it's there. Several commentators asked for relief in the regulations, and essentially what the preamble says is that Treasury and the IRS don't have the authority to change that rule. It's a statutory rule, so they can't change it by regulation. So we're stuck with it until Congress fixes this through technical corrections. And at least as of today, I've not seen much movement on the technical corrections front. One thing to keep in mind is that qualified improvement property is eligible for the Section 179 deduction. And that deduction is now just over $1 million. So a taxpayer can deduct just over $1 million of the cost of Section 179 property. So my point is, if a taxpayer has qualified improvement property, improvements to the interior portion of a building placed in service after the date the building is placed in service, then they can deduct that under Section 179 up to the $1 million limit, even though it's not eligible for bonus depreciation. Now, from here, let's go to page 8, bottom of page 8 in the outline. And this is item A1 on page 8. And we're going to start with the earlier developments and work our way up to the more recent ones. This is in the area of virtual currency. And one thing I should point out is virtual is not spelled as I have it on the slide. It should be V-I-R-T-U-A-L. But we have some guidance on the tax treatment of virtual currency, such as Bitcoin, which is one of the best known virtual currencies, but there are many of them. And the earliest guidance we had on that was Notice 2014-21, which is what is summarized in item 1, beginning at item 1, at the bottom of page 8 in the outline. And essentially, what the IRS told us in Notice 2014-21 is that virtual currency, such as Bitcoin, is not a currency for tax purposes. So it's not subject to the tax rules for currency, like foreign currency. Rather, it is treated as property. And further, the notice says that the receipt of virtual currency in exchange for goods and services is taxable at the time of receipt. And of course, we have to convert its value into US dollars. And there may be a little bit of flexibility because there are various exchanges for Bitcoin, for example, online throughout the world, and each of them might have a slightly different value for Bitcoin. But the idea is if the taxpayer receives virtual currency in exchange for providing goods or services, that they have to include that virtual currency in their amount realized or treat its value as the compensation received by converting its value into US dollars. Now, there's also a process known as mining with respect to Bitcoin. And I don't profess to understand all of the details of it, but essentially what it involves is individuals effectively allowing the use of their computing power through their computers to go through this process of mining Bitcoin, that is, of essentially creating them. And a taxpayer receives a form of compensation for doing that, for for giving up some of their computer resources for that process. And what the compensation is in the form of Bitcoin. So what the notice says is that mined virtual currency is included in gross income upon receipt. Now, the notice does not talk about the character of it, but it seems like it should be ordinary income. So those are the principles. So for example, if an individual performs services and receives Bitcoin that has a value in US dollars of $1,000, they have to include $1,000 in gross income. If the taxpayer is selling an asset in which they have a basis of 600 and they receive Bitcoin with a US dollar value of 1,000, they treat 1,000 as their amount realized, and they compare it to their $600 basis. They then have a gain of 400, which is includable in income. So we treat Bitcoin as property received for goods or services. Now, item B on page 10 discusses the little guidance we have, which suggests that virtual currency appears not to be reportable on the FBAR. There have been IRS officials who've made comments about this in various settings. And most recently, the Journal of Accountancy, this is at the top of page 11, the Journal of Accountancy reached out to the AICPA's Virtual Currency Task Force. So this was a report in the Journal of Accountancy in which they described the AICPA's Virtual Currency Task Force reaching out to the Treasury Department and specifically asked the question whether virtual currency is reportable on the FBAR, and they received the answer no, at least not now, but that could change in the future. Now, item C on page 11 describes how the IRS announced a virtual currency compliance campaign back in 2018. And the IRS announced that it was going to be contacting taxpayers and engaging in various forms of outreach to try to make sure people are educated on the tax treatment of virtual currency and the need to report it. Some of you may have clients who had to report virtual currency on the tax return and reported it on Schedule D as much the same way that you'd report the acquisition and disposition of corporate shares. Now, item D on page 11 describes how the IRS began contacting taxpayers in July of this year. And they contacted taxpayers by sending out letters to those whom the IRS thought might not have reported accurately their virtual currency transactions. And the letters essentially urged taxpayers to take appropriate action to consider whether they reported correctly, and if not, to go back and amend their returns. Now, the IRS in that letter has urged taxpayers to take those letters very seriously. This is part of their ongoing compliance campaign. And the reports on this say that more than 10,000 taxpayers received those letters. Now, in October of this year, the IRS issued Revenue Ruling 2019-24. And this guidance addresses the tax treatment of certain aspects of virtual currency, which again, I don't profess to understand. They are things known as hard forks and airdrops of virtual currency, and provide guidance on whether these are taxable events or not. Now, finally, we have the IRS most recently releasing a draft Form 1040 for 2019. This was in October. And Schedule 1 of the 1040 has a new question that appears at the very top of Schedule 1. And that question asks, at any time during 2019, did you receive, sell, send, exchange, or otherwise acquire any financial interest in virtual currency? And you have to check yes or no to that question. So those are the developments on virtual currency, and in a fair amount of activity recently with respect to virtual currency. Now, let's go from here to page 11. Page 11, very bottom, item 2. And here we have the beginning of what is a fairly lengthy write-up on qualified opportunity zones and qualified opportunity funds. Now, these were created in the Tax Cuts or recognized in the Tax Cuts and Jobs Act. And so they've been around for a while. There have been a couple of recent developments, and those are proposed regulations which were issued just over a year ago in October of 2018, and then a second set of proposed regulations issued in May of this year. And I thought we would talk about these because I've not included an extensive write-up of these in the outline before, and they are getting a lot of attention. So when I talk with people around the country, I find that this is one of the topics that people are very interested in. And essentially, what Congress did in the Tax Cuts and Jobs Act is to enact two code provisions, section 1400Z-1 and 1400Z-2. So I guess these are about as hip as you'll get with code sections, right? With the letter Z in there. So fairly oddly numbered code sections. And these code sections relate to qualified opportunity zones and qualified opportunity funds. And the goal of these provisions is to encourage investors who hold assets to free up their capital and to invest it in economically distressed areas. So the whole theory here is that there are lots of people out there who have assets that they might be willing to cash in and invest in other investments, except the tax hit is a barrier to their doing that. And so what these code provisions attempt to do is to soften the blow of that tax hit and to give some tax benefits to encourage people to go ahead and sell their assets and redeploy that capital in these economically distressed census tracts. And so that is why, that rationale is why the benefits of these provisions are limited to those who realize capital gains. And if a taxpayer realizes a capital gain, then they are potentially eligible for a few benefits, which we'll talk about. Now, what are qualified opportunity zones? Well, they are census tracts that have been designated in every state in the country. And the process was that the chief executive officer, so normally the governor of each state, designated certain census tracts, so looked at all the low-income census tracts in the state and identified, I think it was no more than 25% of them as qualified opportunity zones. So the way in which they were designated is not consistent from state to state. In some areas, some states, the qualified opportunity zones are spread out all over the state. In others, they're clustered in certain areas. It really depends on how the governor and officials in that state designated the zones. Now, there is a particular group, I did not include it on the slide, but I'll mention it here, called the Economic Innovation Group. Economic Innovation Group. And their website is simply eig.org, eig.org. And if you want to learn more about opportunity zones, how they came about, and really all of the rules that apply to them, that's a great resource. Now, that was the process. There are now more than 8,700 census tracts that have been designated as qualified opportunity zones. And what is supposed to happen is that individuals will redeploy their capital by selling off assets, realizing capital gains, and investing in qualified opportunity funds. What's a qualified opportunity fund? Well, it is an investment vehicle that could be organized as either a corporation or a partnership. So it could be a C corporation, an S corporation, an LLC classified as a partnership. And so individuals redeploy their assets, they sell off their existing assets, realize capital gains, invest in the qualified opportunity funds, and the fund then invests in businesses in qualified opportunity zones. And so the idea is that we're then generating economic activity in these economically distressed census tracts. So that is the process. Now, the tax benefits of these, which are set forth in the proposed regulations as well as in the statute, are these. First, deferral of gain, and specifically capital gain, to the extent the gain is invested in a qualified opportunity fund within 180 days of realization of the gain. Now, that's the first benefit. So if somebody holds an asset, let's say that's worth $1,000, and they have, well, let's say $100 basis in it, so there's $900 of gain, then if they sell and reinvest in a qualified opportunity fund within 180 days, they can defer that initial gain. Now, one thing that's odd about this, that's different from similar regimes under the code, is the taxpayer, if they have an asset worth $1,000 and they sell it for $1,000 and they realize a $900 gain, is they don't have to invest the $1,000 in the qualified opportunity fund. They can invest only the gain, $900, and defer the gain. And in fact, there is no tax benefit to investing the full $1,000. There's only a tax benefit to investing the $900. So if they reinvest their capital gain within 180 days in a qualified opportunity fund, their gain is deferred until the earlier of two dates. And those dates are the date that they sell their investment or exchange it, their investment in the qualified opportunity fund, or December 31, 2026. That's the outer date. So the longest you can defer the gain is through December 31, 2026, and then you are deemed to take it into account, or you must take it into account in that year. The second benefit that's provided to those who invest in this way is that if the individual or taxpayer, let's say, holds their investment in the qualified opportunity fund for at least 5 years, then they can increase their basis in the qualified opportunity fund by 10%. So that effectively they can exclude 10% of their gain. So in that example I just used, what if somebody acquires, sells off an asset for $1,000, realizes a $900 gain, invests in the qualified opportunity fund, the $900, what's their initial basis in that qualified opportunity fund? 0. They haven't taken that gain into account yet. And if they hold it for at least 5 years, they can increase their basis by 10%, so their basis becomes 90. Now, a third benefit is if they hold the investment in the qualified opportunity fund for at least 7 years, they can exclude an additional 5% of their gain from their income. So they can exclude an additional 5%. Now, in that example, if the person invests $900 their gain in a qualified opportunity fund. After 7 years, their basis becomes 90. After an additional 2 years, their basis goes up by another $45, so it becomes $135. Now, if we put together the December 31, 2026 date, that's the outer date for deferral, and the person has to hold it at least 7 years to get that additional 5% exclusion. That effectively means they have to invest by the end of this month in the Qualified Opportunity Fund, December 31, 2019, to get the additional 5%. But even if a taxpayer misses that, they still get the 10% exclusion if they hold it for at least 5 years. Now, we've talked about the outer date, December 31, 2026. The fifth benefit here is if the person holds their interest in the Qualified Opportunity Fund for at least 10 years, then any post-acquisition gain is excluded from income. So let's say that somebody acquired a Qualified Opportunity Fund on December 1 of this year, 2019. And let's use the example that's here. Taxpayer sells an asset, realizes a capital gain of $100, and they invest in the Qualified Opportunity Fund, which goes up in value to $150. So in other words, there's $50 of post-acquisition appreciation in the value of the Qualified Opportunity Fund. If the person holds that fund for at least 10 years, so they hold it through 2029, December 2029, they get to exclude from gross income permanently that full $50 of gain. So that is a quick rundown on the benefits of these investments. And I think there are a lot of people who sort of feel like they missed the boat because they didn't really look into the details until late, and they're thinking about that additional 5% exclusion. And I guess my response to that is that's a very small part of the benefits. There's still the 10% exclusion, and perhaps even more significantly, there's that permanent exclusion of 100% of post-acquisition gain if you hold that interest for at least 10 years. So there are a lot of other details. You can find those in the outline. There are some unanswered questions and a few problems with this regime as well. But let's go ahead and move on and take a look at our next item, which is a case that is on page 20 in the outline. It's the Mejuelo case, which is a decision from earlier this year from the 11th Circuit Court of Appeals. This is in the corporate area. And the question in Mejuelo was what the taxpayer's basis in his S corporation was. Recall that a shareholder in an S corporation is subject to a limit on deducting losses of the S corporation. And those limits, that limit is the basis that the person has in their S corporation shares and the basis they have in any debt of the S corporation owed to that individual. So here, what had happened was the taxpayer had a network of entities. And as what is probably common practice, what the taxpayer did was have his S corporation borrow money from some of the other entities. So had a series of what are commonly referred to by people as due tos and due froms among the entities. And the S corporation in which he held stock had a large loss. That is, had a loss of $27 million. And the question was, how much of that could he deduct? And what he attempted to argue was that he had a certain basis in his S corporation shares, but he also should be regarded as having debt in should be regarded as having basis in debt of the S corporation owed to him. And his rationale was, well, the S corporation borrowed from my other entities, and effectively, that should be treated as if the S corp had borrowed from me. And he used a couple of theories. One is the back-to-back loan theory. There it's clear if there is a back-to-back loan, that works. So if, say, another entity had made a loan to him, and he had then made a loan of those funds to the S corporation, that would be debt of the S corporation to him, which would give rise to basis. But he hadn't done that. He hadn't structured it that way. And so the court, in this case, the 11th Circuit, held that he was really stuck with the form that he had chosen. He had not structured it as debt to himself, but as debt to his other entities. Now, the other theory he attempted to use was the incorporated pocketbook theory. And there the idea is that if the corporation is paying personal expenses of the individual, that it is really creating debt. If the person is paying debt, paying expenses of the S corporation, that is treated as debt of the S corporation to him. And the court distinguished those cases and said, no, this is not an incorporated pocketbook theory. So to me, the cases are a reminder that if we want an S corporation shareholder to get basis for purposes of deducting losses, we have to think about how we are structuring the debt of the S corporation. And debt to another entity owned by that person is generally not going to work. Now, we'll jump over to page 26. There are a couple of other items I'll come back to briefly. But over on page 26, we have the Myers case, item 1, which is a decision, again, from the 11th Circuit from earlier this year, that dealt with an individual's responsibility for trust fund recovery taxes, employment taxes, that were unpaid by a corporation. So this individual was the chief financial officer and co-president of 2 corporations, and he was a responsible person, as that term is defined, for purposes of the trust fund recovery taxes. And the IRS sought to hold him liable for the unpaid employment taxes of the corporation. What he argued was essentially the boss told me to do it defense, which historically has not worked. But the difference in this case was the boss was another federal agency, the Small Business Administration. So the corporation in question was in receivership, being administered by the Small Business Administration. And according to the taxpayer, the Small Business Administration directed him to use the corporate funds to pay other creditors rather than the employment taxes. And what the court held in this case is that that did not relieve him of liability, that he had still willfully failed to pay the employment taxes in question. Now, there are a few other items that I thought I would point out in the outline. The first of those is on page 19. So page 19, item 1. And this is notice 2019-59. And notice 2019-59 was issued in November of this year, so just under a month ago. And you'll find the summary of it on page 19. It deals with inflation-adjusted figures for 2020 for qualified plans. And really the only thing I'll point out about this is that the limit on contributions to IRAs has not changed from 2019. So that generally is still $6,000. Now, on page 20, item 1, we have Revenue Procedure 2019-44. And this again was issued just under a month ago in November. This is the annual revenue procedure that the IRS issues with inflation-adjusted figures for the following year. So if you're curious about inflation-adjusted figures for 2020 under the code for any item, this is where you'll want to look. And the write-up on page 20 gives the figures for the standard deduction for 2020. That's going up slightly as we'd expect it to. So for a married couple filing jointly, for example, the standard deduction is now $24,800 for 2020. It was $24,000 in 2019. Now, on page 23, we have item B, which is a draft of Form 1065, the partnership tax return, and a draft of Schedule K-1, and that's issued for the 2019 tax year. So, in other words, for the upcoming filing season. And there are some significant changes on the 2019 Form 1065 and Schedule K-1 that are summarized there on pages 23 and 24. Now, to understand where some of this is coming from, we have to back up and look at the previous item in the outline, which is item A. Well, actually starts back on page 21. Page 21, item 1, and then page 22, item A. In the 2018 Form 1065, the instructions directed that if the partnership was not reporting tax capital accounts on the Schedule K-1, and if a partner's capital account was negative at the beginning or end of the year, then the partnership had to report certain information about that on Schedule K-1 with specific codes. Many partnerships were not aware of that, were taken by surprise, and so the IRS gave some penalty relief, which is discussed in the outline, if certain corrective action was taken. But now, in revised Form 1065 and Schedule K-1, as indicated at the bottom of page 23, the Schedule K-1 for 2019 requires partnerships to report each partner's capital account on a tax basis, regardless of whether the account is negative. Now, before, the Schedule K-1 gave the option to report capital accounts on a tax basis in accordance with GAAP, in accordance with Section 704B, or on some other basis. Those choices are gone, and now we have to report tax capital accounts. And I think what that's going to mean is, for many taxpayers, it's going to require some historical analysis and then rolling forward to arrive at current tax capital accounts. So there could be quite a lot of work involved for clients in that situation. Some of the other changes are described on page 24 of the outline, and one of them I'll mention is reporting a partner's share of net unrecognized Section 704C gain on Schedule K-1. So it used to be that we could report if a taxpayer contributed property with a built-in gain or built-in loss in the year of contribution, but that was it. Now this is an ongoing requirement that we report a partner's share of unrecognized gain or loss from prior year contributions on the Schedule K-1. And again, I think there's going to be some more work involved as a result of that. So you'll want to take a look through these drafts if you work with these partnerships. Page 25, I'll simply mention that we have a decision from the District of Montana, Bullock versus Internal Revenue Service, and some proposed regulations responding to this. This action, the Bullock action, was to challenge the IRS's decision that was made in Revenue Procedure 2018-38 not to require Section 501c4 organizations to disclose the names of substantial contributors on their Form 990s. And in Bullock, Governor Bullock of Montana, the former Democratic presidential candidate, challenged this revenue procedure as invalid for failing to comply with the Administrative Procedure Act for lack of notice and comment procedures. And the District of Montana sided with the governor on that. And the IRS then responded to that with item B on page 25, which is a set of proposed regulations that now put this out for notice and comment as required by the Administrative Procedure Act. Now, that is the last item that we will cover this month. I thank you very much for joining me. As a reminder, there will not be a First Wednesday tax update in January. So in January and July, there is no webcast. So the next one we will have will be in February. So I wish everybody a very happy holiday season and a very happy new year. Thanks very much.